Hello, everybody. The topic of this section is constructing a financial planning model. Financial plans are usually embodied in quantitative models derived in whole or in part from a firm's financial statements. Suppose that the financial statements are the only information about the company available. How could one formulate a plan for the coming year? In this section, we will discuss this problem mainly. Based on the available financial statements, the percent of sales method is the simplest approach to make a forecast of sales for the next year and assume that most of the items on the income statement and balance sheet will maintain the same ratio to sales as in the previous year. There are 4 steps in the percent of sales method. Let's illustrate the method with GPC specifically. Suppose that this table shows GPC's income statements and balance sheets for the 3 years 2021 to 2023. We aim to construct a financial plan for the year 2024. The first step is an examination of past financial data to determine which items on the income statement and balance sheet have maintained a fixed ratio to sales. This enables us to decide which items can be forecast strictly on the basis of our project sales and which have to be forecast on some other basis. In the case of GPC, the cost of goods sold and EBIT in the income statement have maintained fixed ratios to sales. Note that the fixed ratios to sales of cost of goods sold leads to the fixed ratios to sales of gross margin, and the fixed ratios to sales of EBIT results from the fixed ones of selling, general, and administrative expenses. But the interest expense, taxes, and net income have not maintained fixed ratios to sales. In the balance sheet, the assets maintained fixed ratios to sales. The following specific items, cash and equivalents, receivables, inventories, and property, plant, and equipment also maintained fixed ratios to sales. But most liabilities with the expectation of payables have not maintained fixed ratios to sales. The second step is to forecast the sales. Because so many items are linked to sales, it is important to have an accurate sales forecast and later to test the sensitivity of the plan to variation in sales. For GPC, we will assume that sales will continue to grow by 20% next year, so that sales for 2024 are forecasted to be $288 million, multiply 1 plus 20%, $345.6 million. The third step is to forecast those items on the income statement and balance sheet that are assumed to maintain a constant ratio to sales. Because cost of goods sold has historically been 55% of sales, the 2024 forecast is $345.6 million multiply 55%, which is $190.08 million. Then the gross margin is sales less cost of goods sold and is $155.52 million. The selling, general, and administrative expenses have maintained a fixed ratio 15% to sales. The corresponding forecast is $345.6 million multiply 15%, which is $51.84 million. The EBIT are equal to the gross margin less $51.84 million. For the balance sheet, because total assets at the end of the year have been 3.6 times annual sales, the total assets forecast for the end of 2024 is $345.6 million multiplied 3.6, which is $1,244.16 million. Because the items following assets also maintained fixed ratios to sales, the value of each item is forecasted to be sales $345.6 million multiply the corresponding fixed ratio. The specific calculations are given as follows. The payable in liability have maintained 18% to sales, so the forecast is $345.6 million multiply 18%, $62.21 million. The final step is to fill in the missing items in the income statement and the balance sheet. That is, the items that do not maintain a fixed ratio to sales. Assume that the interest rate on the long-term debt is 8% per year and on the short-term debt 15% per year. The total interest expense for 2024 is the short-term and the long-term debt in 2023 multiply the corresponding interest rates, that is 501.72 multiply 8% plus 150 multiply 15%, and is $87.26 million. The taxes are assumed to be 40% of income after interest expense. The taxes are equal to the EBIT $103.68 million minus interest expense $87.26 million. Altogether, multiply the tax rate 40%, which is $6.57 million. The net income after tax is equal to EBIT minus interest expense minus taxes and is $9.85 million. Suppose that the GPC will pay out 30% of net income as dividends. Then, dividends of 2024 will be net income $9.85 million multiply 30%, $2.96 million. The left 70% of net income is the change in shareholders' equity, $6.9 million, rounded off to the second decimal place. The forecast of the income statement for 2024 has been completed. Now, let's consider the balance sheet at the end of 2024. In step 3, the forecast of assets section has been completed, but the liability section have not. According to the results in step 3, the total assets will increase by $207.36 million, and the payables will increase by $10.37 million. Because GPC will pay out 30% of net income as dividends, shareholders' equity will increase by $6.9 million from $333.24 million to $340.14 million. To find the total need for additional funds to be raised either by issuing new stock or by increased borrowing, we subtract the increase in assets as follows. The additional financing needed is change in assets less increase in retained earnings less increase in payables. That is 207.36 minus 6.9 minus 10.37 and is $190.09 million. So there will be a need for an additional $190.09 million in external financing. Assume that all of this financing will be in the form of an increase in short-term debt. Therefore, the short-term debt will increase from $501.72 million to $691.81 million. Finally, the liabilities will be 62.21 plus 691.81 plus 150, which is $904.02 million. The forecast for the balance sheet is also completed. In summary, in this section, we have studied how to construct a financial plan by the percent of sales method with 4 steps and discussed the calculation of additional financing needed. In this chapter, we have reviewed accounting rules in 3 financial statements: balance sheet, income statement, and cash flow statement. We also analyzed the 5 main steps of the firm's performance through ratios: profitability, asset turnover, financial leverage, liquidity, and market value. The construction of a financial plan has been explained. That's all about this chapter. Bye.